Hey there, all my homeowners. Josh Sternberg from Sternberg Law Group coming at you. I am filming from inside the little nook in my house, so I like to sometimes explain my background so people are not guessing as to where I may be. I'm an island off the coast somewhere, but no, I'm just sitting in my house, hence the background. I haven't talked about Chapter 7 bankruptcy in a while. Most of our firm, we focus on Chapter 13s because it has a carve out for people to save their homes through repaying or reorganizing their mortgage arrears or mortgage debt. But in this video, let's talk briefly or for a few minutes about Chapter 7 bankruptcy. To look at Chapter 7 bankruptcy is that you are trying to discharge unsecured debt. Okay, that's the main focus. Unsecured debt is synonymous with credit card debt. So if somebody has $60,000 in credit card debt, each month they may be paying something like $1,500 to $1,800 just to maintain that $60,000 in credit card debt. But as they pay that $1,500 to $1,800, they're not even chipping away at the principal, which is the $60,000. That's a very dangerous way for people to live because it usually brings the amount of money you have in your bank account either down to zero or to negative. And if it brings it down to zero or negative, you find yourself in a position where you're borrowing money to pay off interest of money that you've already borrowed. That's a very common Chapter 7 scenario, but there are different types. People may be going through divorce, people may have borrowed money for their businesses, and they really just want to discharge that debt so that they can go from having a lot of unsecured debt, credit cards, loans, things like that, and then bring that down to somewhere in the $0 range, assuming all of it is dischargeable. If you have $60,000 in credit card debt, you can file a Chapter 7 bankruptcy. In a short 3 or 4 months, you can receive your discharge, they close your bankruptcy, that debt is gone, and then you're free to move on with your financial life. It does affect your credit, of course. Let's make a point there. The number one drawback of all types of bankruptcies is negative credit reporting. But a lot of times people, if you have $60,000 in credit card debt and you've already started missing some credit card payments, your credit may already be damaged. So the credit portion is not as important as people who have great credit. Okay, I don't want to sugarcoat things for you. Credit is very important. It's very important for different reasons for different types of people. So that's something you have to look into on an individual basis. Something you should discuss with your family, with your spouse, with your attorney. So in a Chapter 7, there are a few things that you should watch out for. Number one, if you have too much income, you probably won't qualify for Chapter 7. If you have too many assets, especially if those assets are what's considered unexempt assets, then you probably won't qualify for Chapter 7. Now, what does that mean? Let's give a really easy scenario. The same person who has $60,000 in credit card debt, let's say they have $60,000 in their bank account. No good for Chapter 7 because the $60,000 in your bank account, they're unexempt assets. And then those assets can be liquidated and used to pay off your credit card debt. So not a good reason to file Chapter 7. So when we talk to a Chapter 7 potential filer, a Chapter 7 potential debtor, we first ask what type of debt do you have and how did you acquire this debt? And then we find out what is your income, okay? And make a quick note here. What is your household income? If it's a husband and wife, you need to include husband and wife, and you need to include all sources, especially in a community property state, because I'm in California, so I'm speaking California law right now. And then you want to do a quick review of assets, okay? Big assets, money in the bank, insurance policies that may have cash values, automobiles, homes, other types of property. So somebody might own a home that they live in, and that home is exempt because there's a large homestead exemption, but they may own a second home or an investment home, a home with their family in a second piece of property, and that home may not be exempt. Okay, so that's very challenging as well. So in a Chapter 7, you have to be very careful in your analysis. Believe it or not, you have to be more careful analyzing a Chapter 7 than a Chapter 13. Because once you file Chapter 7, if you have unexempt assets, you're stuck in the Chapter 7 and the trustee is going to sink his teeth into your file to take those assets from you. So like I said a second ago, it could be the $60,000 in your bank account. It could be your family home that you own with your siblings or your parents or something to that nature. So you have to be very careful when analyzing for a Chapter 7. A Chapter 13 typically has a right to dismissal or conversion. So in a Chapter 13, not always, so don't take this as always. Again, you have to speak to your attorney and every situation can be different. In a Chapter 13, you have a right to dismissal, so you're less concerned about getting stuck in a case and having your assets liquidated. I hope that helps people who are looking for more information on whether or not they qualify for Chapter 7 or that Chapter 7 is right for them. My name is Josh Sternberg, Sternberg Law Group. You can make any comments in the comment section below. Please subscribe, like, we really appreciate it. Thank you, everyone.